Geetha, you had a note out coming into this report, and I'm just going to quote it directly. You said there was going to be a lot of focus on plateauing engagement, content creation, AI concerns, muted margin guidance, and an M&A overhang. I know we only learned so much from the actual report that they put out, but what did we learn? And are you feeling any better about Netflix now than where you were a few minutes ago?
Not really, Romain. So, we were kind of looking for some kind of guidance raise, either the revenue numbers or the operating margin. They really didn't do either of that. And then, of course, the all-important number was the third quarter guidance, which, as you pointed out, came in way below consensus. So 11.7% is what they're guiding to. Consensus was expecting just a touch above 13%. So again, not a lot to get excited about, and really kind of feeds into that whole bearish argument about all of the things that you highlighted, especially plateauing engagement.
Well, let's talk about plateauing engagement, because we did hear from the company that the amount of time that people spend on Netflix grew 2% in the first half of 2026. The company highlighting that they had competition from the World Cup, the Winter Olympics, among other things. That 2% figure, how do you feel about that?
Yeah, so this is partly because of the law of large numbers, and to be expected, I think. But we've been used to seeing in the past, Katie, engagement growing in the mid-teens. So when you kind of see this really dramatic slowdown to the low single digits, obviously it does spook investors. Then again, you kind of look at those World Cup numbers, and this is exactly what I think investors were fearing. Like, that is definitely going to have a demonstrable impact on the 3Q guidance, and voila, we did see the 3Q guidance come in a lot lower. So again, and then there's of course that Nielsen report, which points to Netflix engagement or a share of TV viewing time in April, which was the lowest in about 10 to 11 months, and far lower than the 9% that they saw at the end of 2025. We were at about 7.8%.
Yeah.
Meanwhile, you see YouTube consistently growing. So this is where really a lot of the fear is kind of coming in, and today's report really does nothing to assuage that.
Well, that's what I'm curious about too, because Geetha, we talk about their competition with YouTube, and they've articulated that on their conference interview several times. But it's a totally different format. At least generally, the types of videos that you get on YouTube are a lot different than the type of content that you're going to get on Netflix. So it's not necessarily a one-to-one. And do you have any sense here as to whether Sarandos and the other executives would try to push a little bit more into the type of content that you do see on YouTube? Or can they sort of turn things around with, I guess, the more traditional big movies, big series shows that they are used to putting out?
Yeah, absolutely. They are definitely going to put out more of the traditional content, as you pointed out. The shows, the movies, and that is exactly what they were going after with that Warner purchase. But they're also realizing that they have to compete against short form content. And at the end of the day, everybody only has 24 hours, and it's about how much time are you going to be able to spend on the Netflix platform. And so they have to kind of come up with a better strategy for content diversification, and they're doing that. So in the beginning of August, we are going to see them debut some short form content. They're getting content from different publishing sources, BuzzFeed, Condé Nast, People, Variety. So that's really kind of them taking on YouTube in a very small way, but still kind of going after that content. But at the end of the day, again, they are competing against all of these social media platforms. It's not just the big streamers like a Disney or an Amazon Prime Video. So they do have to articulate, better strategic direction, I think.
Yeah, absolutely. And you think about Meta, too. Announcing that it's also exploring new formats. Instagram for TV, that's a platform that Meta is looking at. And we know that Instagram has had success when it comes to Reels. And so, Geetha, when you add it all together, you think about the competition that they're seeing from the short form side. Do you have the confidence that, okay, yes, they need to do something there, but do you have the confidence that they'll actually be able to gain some traction in that space? Because, it's pretty saturated at this point, and it seems like everyone is trying to engineer their own strategy.
I think, in the near term, we're obviously going to see, I think, a lot of noise, a lot of volatility. At the end of the day, they speak a little bit about this in their investor letter about those AI related savings. And I think it comes down to how they can harness and harvest those savings into more differentiated content. So yes, allocating a little bit of that for short form content, but then really going after the content that is going to help them monetize better, which is advertising. So really kind of getting more into live and sports. They've dipped their toes a little bit, but it's just not been enough, because if you look at their content budget, it's $20 billion this year. They spend about less than 4% of that on sports content. They really need to, I think, really beef that up pretty dramatically. I mean, you look at Disney spends about 40% of its budget on sports rights. So, they absolutely have to do something to move the needle here.